everyone, to episode 7 of the UnPACing Alpha podcast. I'm Sebastian Lander, portfolio manager at PAC Capital, and I'm very lucky today to be joined by Anthony Kirkham down in Melbourne from Western Asset. Thank you, Anthony, for your time.
Pleasure, Seb. Great to be on.
Fantastic. So maybe we'll just start with, who are Western Asset and what's your role there?
Yeah, Western Asset's a globally integrated active fixed income manager. So it's been operating for over 50 years, which, is quite a feat within fixed income because you've certainly seen a number of houses come and go. But yeah, we've got 133 investment professionals across the globe in 7 offices. And I actually head up the investment team here in Melbourne, where we manage over 18 billion in fixed income assets across both Australia and New Zealand.
Wow, brilliant. Yep. And Western Asset are part of the bigger Franklin Templeton group. So do you want to just maybe touch on that relationship, and then also, I guess, maybe the benefits of being part of a global group like Franklin Templeton?
Yeah, it was quite an interesting time when Franklin purchased Legg Mason. So Legg Mason had owned Western Asset since 1985, so a long period of time. And obviously it happened during the pandemic. That wasn't planned, but that's how it turned out. So in July 2020. So it's nearly 3 years. And yeah, look, Franklin Templeton, obviously a very financially strong firm. It has the resources to really properly support our business. And that's really important in terms of if we need seed money for anything, and they certainly can do that. And obviously in terms of other services as well. So that's really key. And they're definitely, the world's top cross-border fund manager. So they've got offices in 32 countries, which really does bring a larger distribution base than we had previously. And we've definitely experienced this over the past few years in terms of asset growth, particularly on the retail front, where they have a really deep bench of professionals. So yeah, look, we're very happy, and that's working out well for the firm.
Great. And you mentioned you manage 18 billion in fixed income strategies. Do you want to just touch, I guess, on the main funds, maybe the flagship fund and some other offerings that you have?
Yeah, for sure. I mean, obviously, as a firm at Western, being full spectrum fixed income firm across the globe, we obviously have the scale and expertise to cover anything fixed income, really from liquidity products all the way to high yield and emerging market. In terms of what we do locally, we have a number of funds on offer in the retail wholesale market that includes really anything from conservative income product to a broad Australian fixed income fund. We've got an Australian credit offering, as well as a global bond fund that's sort of a full global bond fund where it can certainly add value in a number of different ways. And then we've got a global macro opportunities fund. So that is a real total return style fund that seeks to maximize that. So there is quite a broad offering, but I'm sure, as time passes and people's flavors change, then we can certainly bring further product into the Australian marketplace.
Okay, great. And all those funds are available on platforms, and some of them retail as well?
Yeah, absolutely. No, all of those. Yeah, they're all available. Different platforms, obviously, but yeah, they're all available. So, as I said, we'll certainly look to bring other product as people's interests change.
Okay. Yeah. And then I guess the Australian fixed interest space is a pretty competitive space. So, what would you say is your edge? What differentiates Western from some of your peers?
Yeah, look, there's a number of critical factors, I guess, that differentiate us. I mean, certainly locally in terms of the team, it's incredibly experienced and fortunately also very stable team. So it's average of 26 years industry experience, nearly 18 years with the firm. So that's pretty unusual. And I think the important thing with that is that we've managed bonds through multiple scenarios, as we've seen over the last few years, and definitely multiple cycles as well. So importantly, our performance, which is award-winning, it's owned by the current team, which I think is really important for investors. And this experience actually and tenor really extends across the globe, which is, pretty important as well for the Australian marketplace, because we have around 50% of our corporate issuers are actually domiciled offshore. So as a result, having that globally integrated team, we can tap into those analysts, who know those companies really well. They know the industry that they're in, their competitors, obviously, and most importantly, management intimately. So therefore going to provide us as portfolio managers in Melbourne the insight required to make really fully informed decisions. So I think that's certainly key. Also, our analysts sit on the desk, which is not normal. Sometimes you have analysts sitting in a room and they write things and send it out and hopefully get read, but they actually sit on the desk with the traders and the PMs, and therefore provides them with much greater color in terms of what's going on in terms of the securities and how they're trading. So when it comes to recommendations, it's more than just, the financials. It's a lot more than that, which I think is really helpful. As well, we get desk reports on a daily basis. So we walk in the morning, we know exactly what the team's been doing globally across all sectors, which probably is not critical for us down here in Australia and managing money in New Zealand as well. But it gives you that flavour in terms of the direction and cycle of markets. And then I think probably the real difference is around the team culture that we have globally. We're actually a large scale firm. But the important thing is we actually really feel small because there's a real, and I don't want to say it, but because it sounds quite American, but it is quite a collegiate culture, if you want, where everyone is very supportive through both the good and bad times, and therefore there's a real sense of purpose, I guess, to succeed as a team, which I think is most critical. And probably the other thing that sets us apart, we don't have, vice president or president titles on our cards or anything. It's a very flat management structure that is done on purpose because it allows everyone to be heard, to take view on markets. We're able to have healthy debates. And the CIO, importantly, encourages everyone to take a view. So he's not one that prescribes a certain way of thinking. And we're in fact expected to find value in our local markets, share these ideas. And I think that is why, people generally stay at Western for a long time.
Okay, it's very, very impressive. There's a lot there that I want to drill into if I can. Maybe we'll start with just initially. You sort of mentioned that 50% of, I guess, your universe is actually offshore sort of borrowers issuing bonds in the Australian market.
Yeah.
So is your opportunity set is pretty broad then compared to, say, a DIY investor trying to do this or a smaller house?
Yeah, absolutely. And I think that sort of differentiates our bond market and certainly is a standout relative to, say, New Zealand market, where they tend to like to keep the issuers domestic in nature and then invest offshore to get that exposure. Whereas in Australia, we've really embraced issuance from, we call them kangaroo issuers, so that we're getting that extra flavour within the investments, which I think is great for investors, because then you don't end up with concentrations just around banks or REITs or other sectors that obviously are much deeper here in Australia. You get that broad sector that you really need within your portfolio. So now in the case of Australia, a lot of these companies do have businesses here, obviously, and that's what they're funding, but some don't. Some are just looking to get investment grade funding from other alternate markets, just to give them options when it comes to funding their businesses. So it's therefore really critical, obviously, to have those analysts to provide that insight so that you can make, as I said before, informed decisions.
Great. And I guess I'd pick up on something else you said. You sort of mentioned that the team has managed money through good and bad times.
Yeah.
Where are we today? Are bonds back? Is this a good time? Can you maybe contrast today versus the back end of 2021?
Yeah, look, it's been certainly a big change, incredibly painful one for investors in all asset classes, no question. Most definitely in bonds, though, obviously, because we're central to those changes. And certainly my career of 32 years plus, 94 has always been talked about as the worst year for bonds. But yeah, last year, 2022, way surpassed that. And it's obviously been driven by that policy experiment that central banks have really been on for the past few years, particularly through the pandemic. But then you can even draw it all the way back to the GFC, where some markets really haven't had the ability to operate normally because central banks been manipulating yields down to obviously, generate some activity. So it's been a long period of manipulation, but I guess and therefore distortion of prices across the board, and that has a big impact in terms of markets generally, because as you know, equities get marked off um, where funding is and where bond yields are, in terms of calculating those ratios, and so therefore that has impacted where people have been forced to go with regards to investing, and it's questionable whether some sectors would even exist today, like crypto, if it wasn't for that need to obviously take risk because you weren't getting any sort of return from putting your money in the bank and going out and trying to find some sort of return on your money. So it's certainly changed people's thinking, and therefore, really, I guess, press markets with regards to valuation. So, as I said, look, it's been incredibly painful for bonds, but certainly in other sectors as well. And obviously, this, I guess, manipulation ended pretty quickly. Obviously, as inflation came back, they put those new toys away, I guess, somewhat, and then we're seeing this incredible unwind. So I think the great news for bonds, and certainly, something that I wasn't sure was going to happen, as I said 18 months ago, when a 10-year bond under 1%. But the thing is that bonds are now back in a place where they can offer a very attractive yield. The correlation benefits that you buy bonds for relative to other risky asset classes is now back in place, and therefore you've got that defensive attribute that you're looking for within fixed income. So for me, that's pretty exciting, and I think it should be exciting for investors broadly, because for a period there we really didn't have it, and now it's back.
Yeah, I'd agree with that. So maybe we could just focus or just touch on the correlation benefits you sort of discussed. Maybe you could just, I guess, provide a bit more color around that for some listeners.
Yeah, look, I guess the thing is that, a lot of people do get caught. In Australia's, like, if you look at the data, it's quite clear that unfortunately investors in Australia don't have an affiliation to buy bonds. It's very different in the US market, where they basically have this philosophy where as you get older, you should be adjusting your overall portfolio to allocate to bonds based on your age. So clearly at 40, you got 40%, at 60, you got 60%, 80, obviously, because you're taking out some of that sequencing risk that's going to impact you later on if you had a down market and all your assets were sitting in a risky asset class that was impacted by that. So the important thing is to have a sector that you can go to obviously in those periods. You will see bond yields, like at the moment, obviously incredibly attractive. They're providing you a nice return. But the important thing is that if bond yields were forced lower by a slowing economy, a recession, which is certainly on the cards, we'll probably touch on that. But the price of bond, obviously the yield moves down, but the price of bond goes up. So it provides that offset for your risky assets, which is important to have. As I said before, for the last few years, it hasn't existed because central banks have manipulated yields down to ridiculous levels where they could not even really provide a yield, let alone, that impact required as things unwind.
Okay, thanks for that. So maybe now we'll move on to more of an open discussion and maybe about the RBA and what have you. I mean, maybe just to start though, would you say that forecasting RBA policy is sort of critical to your strategy as a bond manager?
Yeah, look, I mean, predicting RBA policy is somewhat important, but other factors are much more critical to really long-term pricing of bonds. So, predicting inflation and growth are clearly key for the shape of the yield curve. And therefore, getting this right is going to be much more important for long-term performance than obviously calling whether the RBA is going to tighten this month or next month. That's a little less impactful. I mean, clearly, you want to get it right because it does impact short part of the yield curve and sometimes the longer end, but it's the overall view which is going to be really key. So that's what you really want to get right through a cycle.
Okay, makes sense. Thank you. So now I guess RBA policy. So we're recording this on Thursday, the 8th of June, 2 days after the RBA has increased rates another 25 bips to 4.1%. I think 5 bips of tightening was priced in, so a bit of a shock. It was a shock in May to sort of many when they raised rates then. Do you have a view? Do you think the RBA's done too much here, that they should be sort of waiting for some of this, I guess, tightening that they've done to feed through to the economy?
Yeah, look, it's a very tricky one, right? I mean, and it's been very difficult to read the RBA, but at the same time, it's been a challenging period for anyone to predict sort of how the economy was going to behave over the past few years, particularly as the globe obviously had to deal with a pandemic. So, there was a lot of fiscal stimulus thrown at it, and probably more here than most other places. But certainly a lot. And that easiness of monetary policy, which we touched on, is also unprecedented. So, you've got a lot of sort of drivers there that, there's sort of no playbook for in history, really. So I want to take a little bit of pressure off them, because I don't think it's been easy for anyone. And you've got to throw in sort of some of those other factors as well, where clearly, the war in Ukraine was really did throw out, in terms of impacts on inflation, pretty heavy weight, due to the fact that energy prices really got moved quite substantially, and also food prices as well. So it's that has certainly played havoc. And the other one probably worth noting is the fact that obviously countries exited it COVID lockdowns at different speeds and different times. So that's really played havoc on demand and supply. So I'm just trying to take the pressure off them a little bit. But at the same time, look, it's been difficult to read. They really have waxed and waned in terms of their view. And even this year, you could certainly say that you've seen that in terms of the way they started out the year, obviously quite concerned about where inflation was, then got sort of Q4 GDP numbers and realized, the consumer is slowing up a bit. So you had a pause, and then, back on again in now May and June. So, there's clearly been a change of thinking, and understandably too. Like, the stickiness of inflation has really been quite clear. But at the same time, as you highlighted, monetary policy has a lag. Everyone knows it. Every economist knows it. I'm sure everyone's sick of hearing it, but it generally has a lag of 12 to 18 months. So it does take time to actually work through the system. And I think, as you highlighted, we haven't really given it a lot of time to actually take effect. But central banks globally, have been looking for inflation, ironically, for, the last 10 years, and haven't been able to find it, and suddenly it comes in spades. And now they're like running, to try and squash it back down again. So it's been a challenging period from that perspective. But I think that, unfortunately, and it's very clear in terms of the statements out from Governor Lowe this week, but they have certainly grown tired of being patient on inflation, and they were clearly wanting to protect the gains that we've seen in terms of unemployment, getting that down to the levels they have. But they now seem to be moving forward from that, and obviously, did surprise the market somewhat, tightening as they did this week, because in May it was supposedly a 50-50 call, and they hiked, and everyone thought, therefore, they're pretty much done. But since then, there has been some surprises on inflation. Wages, obviously, with the decision, did probably surprise them as well. And I think house prices also challenging them in terms of, seeing that move higher. Yes, there's reasons to actually think that it's a bit of a one-off, caused by sort of higher end prices moving up, and also obviously limited supply. I think on that housing front, is not too many people wanting to throw their house up onto the market this time of year. But for them, they're sort of looking past that at this point, and therefore obviously wanting to get inflation down, and are willing to, as I said, probably challenge that employment growth a little more than originally wanted, to get inflation out of the system.
Fantastic. So when you've hit on a few things I was going to ask, so I guess, so as far as your sort of, or the way you're seeing it, is the RBA isn't done. There's at least one, maybe two more.
Yeah, Yeah, I think that's right. Look, I mean, they're still going to be very much data dependent. I think they're very aware of the pressure that's still coming through the economy, and we know that there's a pressure on the economy just from the fact that prices have increased quite substantially. So people's disposable income has really come down. But the other side is clearly that mortgage side, which once again we're not sort of used to dealing with in Australia because most people typically have a floating rate, mortgage or variable rate mortgage, but obviously through the pandemic they got these special fixed rates which have shielded a lot of people as a result, but unfortunately that shield is now coming down, and most of those are unwinding over basically June, July, August, and so therefore that's really going to change a person's mortgage payments quite substantially if they're moving from a 2% special fixed rate deal to a 7% or close to mortgage payment structure. So it's really going to be quite substantial for a lot of people. And that you can maybe do it for a month or two, but it will certainly start to impact the consumer's ability to spend, and therefore you've got to expect that activity will be coming down with that. So the governor knows that, and yet we obviously continue to see this sort of need to hike, as a result of these surprises that we've had recently.
Do you think the RBA is actually willing to push us into a recession and keep us there with higher rates and tighter monetary policy if inflation is yet to come down? And maybe you can talk about, I guess, the fact that inflation is a bit of a lagging indicator.
Yeah, that's right. I mean, unfortunately, it is, and unfortunately, there are clearly factors that you keep tightening, then inflation will somewhat be, following as a result. And I think housing's one that's been touched on quite a bit recently, where everyone's concerned about the rental prices going up, and that's not super surprising if you've got an investor that has a choice. They own a property, they want to get a reasonable return from it. They can now just choose to, put that money in the bank and get, sort of 4.5%, let's say. So that's pretty attractive. And if you're not getting that in terms of your rental yield, then clearly you need to push it up. So it's sort of a, it's a bit of a circular motion, that if you keep hiking, then there will be pressure in that space. But I think, the other part of your question was the fact that, there's definitely signs that, what they've done already is impacting parts of the community. So I think that's where, it's going to be interesting. They, as I said, this week definitely sound a lot more keen to tighten, to, really get inflation out of the system, and willing to do so at the expense of the economy. And he even highlighted the fact that, he's always been talking about this ability to have a soft landing. Now it's basically talking in a way that that landing strip is looking very slim, very short, and possibly bumpy. So therefore, the outlook is looking much more like one that could lead us into a recession for sure.
Okay, and just on house prices, I mean, I think we've seen certainly in Sydney, house prices are actually up in 2023, and maybe that isn't something the RBA would have wanted to see. They maybe would have wanted to sap confidence there. Do you think these two rate rises back to back in May and June will see, I guess, a different picture for house prices in the second half of this year?
Yeah, look, I think it was going to happen anyway, just in the second half. As I said before, like a lot of the impacts in terms of coming off the fixed rate is really not coming through in terms of impacting the consumer until the second half. So it's not going to happen the first month that someone moves to a fixed rate, or from a fixed rate to a variable, but it will certainly happen over the following months, as clearly they look into their bank account and find, there's limited ability to actually meet this, and therefore start to adjust, their living habits. So I think we've started to see that within some parts of the community. And they're the ones obviously we're going to be somewhat concerned about. And I would say that's where obviously the movement in terms of wages was meant to be focused, because they're the ones most impacted by these price increases, and certainly the pressure on the mortgage front. But it's also quite clear that there are other parts that of the different age cohorts that are really being impacted by this move. And it's basically anywhere from, the 25-year-olds to the, 45-year-olds pretty much. And they're typically the consumers within society. And they're the ones that are really feeling the pressure, I think, in terms of obviously that disposable income really coming down quite sharply as a result of obviously normal prices going up, but also mortgage rates, and at the same time, just uh, you, having worked through a lot of their savings already that have been put together during the pandemic.
Okay, so that actually leads perfectly to my next question. Why hasn't inflation, I guess, come down here as much as it has done in other areas? Is it that savings that were built up in the pandemic and in that period afterwards? And I guess, is there any, without giving away too much of your sort of IP, is there one signal that you're looking for, I guess, in the data that will tell you that the economy and maybe inflation has really cracked here and it will start to roll over meaningfully?
Yeah, look, there's it's an interesting question, just because I think the RBA was sort of scratching their head for a bit there as well. I think there's one component that has really helped us in terms of having that inflationary pressure initially, and that was definitely around wages. Our wages growth was definitely remaining somewhat more benign than in other parts of the globe. You take the US and the UK even, where certainly wages growth was well above 5, whereas ours was still creeping into the 3s, reached 3.5, and obviously I think with this wage decision we'll see it sort of moving closer to 4, and the RBA is expecting that. But that was certainly one of the things that kept inflation here probably a little lower on that front. But as you say, like, it's sort of still coming through for us. Yes, it's come back, but it's still incredibly sticky, which is somewhat still being felt offshore. But I think we are having a little bit of late cycle here. There's a reasonable question around whether we actually, I guess, left monetary policy too loose early on, and we're sort of paying for that. And I think that's a reasonable argument, because clearly we didn't need it at 10 basis points for as long as we did. That was an absolute emergency setting, and yet the RBA and certainly Governor Lowe was supporting keeping it at those levels to get, funnily, wages up to that 3.5% level. And then, of course, as soon as it's hit it, now they're hitting the alarm bells and tightening, reasonably aggressively now at this point. So it's sort of I think we're a bit slow to get going, but now it sort of seems a bit fast, because there's definitely signs of weaknesses in the economy emerging, and that's is just going to make it a little more painful on the other side.
Yeah. And so, are there any indicators that you're looking at to say, actually we could be about to see the data start to all come through and show us that those rate rises are really impacting and growth and inflation is going to fall away?
Yeah, look, there's a number of areas, and I think we sort of touched on certainly housing a little. That was definitely one of those that I think had the consumer. We saw them down sort of 10%, and that obviously was seen as somewhat painful. But we've also seen clearly consumer confidence, business confidence also incredibly low. That doesn't seem, weirdly, to have actually sort of come through in terms of activity. Initially, at least, and now we're starting to see a little bit more of that. And there's certainly some of those forward-looking indicators like building approvals, which are really, really weak. And that's going to be critical, because if you're not building, and it's not just sort of new homes either, it's definitely extensions and alterations as well. And so that sort of plays out in terms of retail activity as well. So it flows through, because clearly if you're not adding, then you don't need to buy that new couch, or buy all new furniture elsewhere in the house, and fridges and everything else. So that's definitely one that has been clear for a little bit, but will be playing out as we move through. I think the other one that's always certainly somewhat forward-looking is just around some of the indices with regards to purchasing managers indices, which globally are sort of seen as a bit of a benchmark for where things are going, because they're somewhat forward-looking with regards to the questions being asked, and they're definitely on the manufacturing side here in Australia moved into contractionary territory, and so that obviously seeing that sector somewhat strained. And then the services sector has been an interesting one. Obviously, we've talked a lot about not being able to find workers to basically open up our restaurants and other parts of that service community. And we saw that certainly in terms of the second half of last year, but that has since moved back into expansionary territory and was looking reasonably healthy, but recently started to roll over. And when you sort of break down some of those retail sales numbers as well, you can start to see that people are making decisions to stay home or eat at home, and making those sort of choices. So, it's slow because it's everyone sort of feeling this pain at different speeds. But I think ultimately, as I said, as we move through into the second half, we will feel that more evenly, and therefore certainly start to impact those activity levels.
Okay. So, I mean, I guess the picture I'm getting from you is that you do see a pretty material slowdown coming.
We do, yeah, yep.
Sorry. Yep.
Yeah. No, yeah. I mean, look, we do. I guess we've been one that has thought that it may be averted. We didn't go into recession. I think that is getting more difficult now as a result of these extra hikes. If they'd been able to remain somewhat pragmatic, it would have been fine. But I guess Lowe sort of said that this week. We tried that, but it doesn't seem to be working fast enough, and so they've lost that patience. So now, yeah, look, we do think that we will certainly head into a mild recession. But I think the important thing is that, unemployment is at, still incredible lows. Like it's at close to 50-year lows. And that, yes, we're going to lose some of that, but I think we're not going to lose it all. And I think the key here too is that the transmission mechanism in terms of monetary policy that the RBA will have when we get through this year is that, we won't have obviously fixed rate mortgages hanging around. They will have matured, generally speaking, and people will be variable again. So as soon as you've got that inflation coming down and they're comfortable it's heading into the band, then of course they can start easing again. And that will provide, I guess, that pressure release for consumers to be able to, I guess, start one, breathing again, but two, start hopefully spending again and get the economy back on kilter. And you don't have that in other parts of the globe. I mean, the US is a good example where the fact that they do have those 30-year mortgages means the Fed is forced to tighten further than they needed to because the impact is so slow. They're locked away and therefore not being impacted for a long period of time, or just on the margin as they lease a car or their credit card, but it stops that new buyer because the rate is high, and then it ultimately grips and then suddenly the economy slows up quite quickly. So in Australia, typically we do have a much more direct system, and that transmission mechanism works in terms of monetary policy, and I think we'll be back to that point relatively soon, and so they can obviously ease the pain. And equally, probably worth highlighting is the fact that fiscally, Australia's in a very solid position. Yes, we talk about the amount of debt we have, but relative to the rest of the developed world, it's actually relatively low. And we can see that, clearly exports, the fact are doing really well, and probably, sadly, and never like to admit it, but we're probably one country that really did benefit from what went on in Ukraine because we're obviously a big exporter of energy and also agriculture. So we've been able to benefit from that, and the government's benefited from receipts. But also having that low unemployment has meant they're not, obviously getting extra tax receipts from those new workers, but also not paying out on the other side. So fiscally in a really solid position, and if need be, they can obviously come through and assist the economy, which I think they did a little bit in that recent budget, but they'll probably have more ability as we move forward to do so if was required. Whereas other countries, as we've just seen with the US, are right up against it from a debt limit perspective and really don't have those tricks the way we have currently.
Great. That was a really sort of great discussion about the economy. Maybe we can finish up this podcast with a pivot back to, I guess, markets and portfolios. So against that, I guess, uncertain and potentially negative backdrop in the economy, What parts of the fixed interest market, so sort of your universe, are you worried about? Which are you avoiding, and where are you overweighting? What areas are you sort of positive or constructive on?
Yeah, I mean, it's great to be where we're at in terms of, as I said before, got yields back up, obviously at high levels as a result of this, tightening that we've been seeing in monetary policy. But therefore, the offering is something that's really attractive for investors because clearly yield is there. It's attractive yield. We've also had a period where, because of that volatility we had in 22, we did see spreads in credit obviously move wider as a result, because that volatility means that traders are uncomfortable. It's moving around too much, and we saw spreads widen as a result. And some of that was obviously due to the fact that, we do expect that the global economy was slowing up. But in Australia, in terms of the types of investments we have, they're in companies that are generally monopolistic or duopolistic. They're regulated assets. So, they're actually really solid assets. So, we don't have some of the risks that you have across other markets, because we are looking at it, really a pure investment grade market, which is somewhat filtered anyway, because investors like ourselves don't like to invest in or can't afford to really invest in companies that are going to travel down into sub-investment grade, because we don't really have the market for it. For the reasons said, like, we're basically feeling quite comfortable with the credit that we own because of that special nature of it. They will perform even in a sort of a downdraft or a slowing economy because they still have pricing power. So we still like the corporate sector, but we're being very defensive. So we're holding it short dated because the yields super attractive. It's going to run into home, so we're not worried about defaults. So it'll run into home, and it'll give us that option to roll into other sectors depending on whether it's attractive or not. What we have seen in our market too, once again through that volatility, is that sectors like supranationals, sovereign agency that do a lot of issuing here have got an incredible yield relative to a Australian government bond. These SSAs, which we call them, are generally rated AAA. Obviously, so is our federal government paper, but you can pick up a whole close to 1% in sort of a 3 to 5 year term by investing in those. So once again, happy to remain relative defensive, but provide and find those opportunities because of the volatility that we've had in markets to obviously pick up that extra yield. And obviously, as I said, most importantly, ensure that this fund will perform the way you want it to through a slowing environment. So remembering that's why investing in bonds, you want them to be defensive, and we certainly barbell the portfolio to ensure that is the case.
Awesome. So if anyone who's sort of watching this podcast wants to find out some more information about you and your team and the products you offer, where's the best place to do that?
Look, you can certainly head to Franklin Templeton website and find that information, or our own westernasset.com. So yeah, look, it's there, and there's definitely a number of avenues. You mentioned before, you can find on platforms. We also have an ETF on the Australian bond side, so you can find that there as well. So yeah, look, there's a number of avenues for investors, which is key.
Fantastic. Well, thank you very much, Anthony. It's been a really interesting conversation, and we really appreciate your time. Thank you.
Yeah, no problem at all, Seb. Good to chat.